So I would like to introduce our next speaker and actually our first sort of panel. So at Yale, we like to think not just about the new disruptive technologies, but also how they affect, obviously, business and also society. And as it kind of became clear throughout the morning today that FinTech has affected society in many ways. In particular, more and more people participate in finance that might not have done it before, and also new roles. So for example, all of you probably have heard of peer-to-peer lending. Earlier, Blythe mentioned initial coin offerings, where now regular investors can participate in providing funds to companies. And FinTech has also reduced the costs of financial transactions and broadened access to credit and investment. And it remains an open question, however, whether these changes will help or hurt incumbents. In the next session, Professor Sorenson will give a talk about the relationship between crowdfunding and venture capital. Then he will moderate a panel exploring deeper who will win and who might lose from the introduction of FinTech. And Olav Sorenson is currently the Frederick Frank and Mary Tanner Professor of Management and Director of the core curriculum at the Yale School of Management. He's also Professor of Psychology by courtesy at the Yale University. His primary stream of research pertains to economic geography, focusing on how entrepreneurship influences the growth and competitiveness of regions within countries. And in particular, he has called attention to some unexpected consequences of the fact that social capital, plays an important role in entrepreneurial success. So thank you very much, Olav.
Thank you, Marina. So one of the courses that I teach at the Yale School of Management is on venture capital. And from a research perspective, one of the things that I've been quite interested in is to what extent does venture capital also maybe influence the real economy? So does it create jobs? Does it create income growth? And by and large, I would say that the answer is yes. I mean, I do think that this is one of the main reasons that people are really kind of oftentimes interested in venture capital, at least from a public policy point of view. They look to Silicon Valley, they see this kind of incredibly dynamic region, and not just a dynamic region. If we looked on a per capita basis, Silicon Valley and the kind of counties that make up Silicon Valley are almost certainly kind of the highest per capita income counties in the United States. But if we sort of think about, if we believe that there are benefits coming from that, one of the potential problems from a public policy point of view is that, there's a lot of inequality in where the supply of venture capital is, right? So in particular, if you look at, this is just 2016 VC investments, Silicon Valley is absorbing almost 50% of all venture capital that's being deployed in the United States. New York City and Boston are oftentimes seen as kind of large receivers of venture capital, but they still pale in comparison to Silicon Valley-based companies. And then once you go beyond that, there's actually relatively little venture capital happening. So, one of the things that I've been interested in, and I think one of the kind of motivations for thinking about crowdfunding, in this case equity crowdfunding, is that perhaps it's going to expand access. And what I'm going to focus on here is whether or not it expands access geographically, but you could also think about expanding access on other dimensions. Does it make it easier for example, women and minorities to access venture capital, or just people that are maybe coming from non-elite universities? If you sort of look at kind of who gets funded currently by venture capital, the entrepreneurs that are being funded look a lot like the VC partners that are doing that funding. And that means that there are a lot of people that maybe potentially have some great ideas that aren't receiving backing. Now, in terms of what I'm actually present, the Jobs Act is about equity crowdfunding. The problem is that even though it was passed several years ago, it didn't actually get implemented till last May, and so there really isn't enough data yet to say whether or not equity crowdfunding is kind of reaching larger geographic areas. So what I'm focused on is basically donation crowdfunding. So this is Kickstarter. Probably many of you are familiar with the Kickstarter platform. This is one of the campaigns that was done on Kickstarter. So, just to kind of review, the nature of these campaigns are, you could probably think of these as a form of pre-sales. So essentially what's happening is, in this case, Oculus Rift, or Oculus, the company, is looking to sell this Oculus Rift virtual reality headset. And they're hoping to get, in this case, they were hoping to get about, I think it was about 1,000 backers to provide each around $300, which would have meant that they would have gotten one of the first headsets. It turned out that there was a massive amount of demand, much more than they had expected, and so they actually raised $2.5 million, which allowed them both to do some additional development on the headset and to essentially, kind of pre-finance some of the initial manufacturing of those headsets. So an alternative form, effectively, of entrepreneurial finance. These platforms, and I'll just kind of go through this very quickly, they've been popping up all over the world. One thing that probably will come up in the panel is, there are different types of crowdfunding platforms. Many of you may be familiar with this, but oftentimes we sort of divide these platforms into the kind of three primary groups. Would be donation-based platforms, of which Kickstarter is one. So legally, the people that are making, sort of having these pre-sales are actually giving Oculus essentially a donation, with the idea that Oculus then will give them sort of a quid pro quo, some kind of in-kind reward for that donation at a later date. The largest segment of crowdfunding is debt-based, or you could think about kind of peer-to-peer lending as being another way of talking about that. And then what's actually quite small here is equity crowdfunding. Since these numbers are only going through 2015, the equity crowdfunding that's making up this graph is not from the US. It's primarily from the UK, the Netherlands, Australia, and New Zealand. So the first thing that we did in terms of looking at this is just said, well, what does the geography of crowdfunding investment look like compared to the geography of venture capital? And just on a very, kind of basic level, it's very easy to see that there's a big difference between where crowdfunding's happening and where venture capital's happening. So if you look at kind of a map of the United States, these are counties, and they're just shaded by how many successful Kickstarter campaigns were there from 2009 to 2015. And you can see that actually, this map, if we were to sort of, an alternative way that we could shade it is to shade it according to the population of the United States, and it wouldn't look too much different. Basically, there are successful Kickstarter campaigns almost every place that you have people in the United States. The map of venture capital looks quite different. So if you looked at VC rounds that have been done over the same period, it's really highly concentrated. And that's not surprising given the graph that I showed you before. A lot of it is concentrated in California, particularly around Silicon Valley, but also up in kind of New York, the Boston area, and a few other handful of places like Austin, Texas. Now, one of the problems in sort of making those comparisons, though, is there's a lot of things that are on Kickstarter that are not the same things as what our venture capitalists are investing in, right? So if you've spent any time on Kickstarter, you know that a lot of the things that are up there are things like, I want to write a play, or I want to produce some piece of art, or maybe I'm a musician and I want to produce an album. Well, we wouldn't expect that venture capitalists should be interested in investing in those things. So it's possible that what's happening is what we're really seeing is that those Kickstarter campaigns that are all over the country are for things that venture capitalists would invest in anyway. And so these are perhaps the regions where there are interesting, say, technology investments to invest in. And so one of the challenges in this research has been to try to figure out, well, how do we come up with a comparable set of sort of projects for venture capital and crowdfunding, or Kickstarter. And so what we've done is we've kind of used all of the Kickstarter campaigns usefully have these descriptions, right? So this is an example of a campaign, and there's this whole kind of free text description of what the idea is. So what we did is we essentially used all of these free text descriptions, and we took similar free text descriptions of the companies that VCs had invested in, and then basically tried to create a mapping for what are types of projects that VCs are investing in that have similar descriptions to the types of projects that Kickstarter campaigns are being run for. And so what we're seeing here is these are basically different types of categories on Kickstarter on the vertical axis, and different categories within the Thomson One Financial database for VC campaigns on the horizontal axis. And then the cells, the blue cells, basically indicate places where there's a pretty high degree of overlap in the types of words that are used in the descriptions, right? And then it has a fair amount of face validity. So, the types of things that are coming out as similar are, computer software games, right? And other types of, kind of technology, either computer software or computer hardware, as well as a few things in, kind of business services. So essentially what we did then is we said, well, let's just limit our analysis to those things that seem to be common for both venture capital and Kickstarter, and say, what does the geography of those look like? So if we do that, what we've got in this map is we're basically looking at what's the relative proportion of investments or the relative proportion of sort of funding that's going to various counties for venture capital versus for Kickstarter. And the way to read this is that places that are, kind of dark, that have the dark kind of brownish coloring, are places where there is, much more Kickstarter money going as a proportion of all Kickstarter funds than venture capital as a proportion of venture capital funds, right? So these are, you can think about kind of net attractors of Kickstarter funding. Whereas at the other end, the light, kind of almost whitish orange, are places where venture capital is sort of dominating the investment scene. So you have a more higher concentration of venture capital. Now, all the gray areas, I should point out, are places where there's just no venture capital, right? So because we're thinking about this as a ratio, that would mean dividing by 0, and so it doesn't really make sense to talk about that. But if you focus on the places where you have both crowdfunding through Kickstarter and venture capital, you can see there's really quite a few differences. So not only is there kind of a broader spread in some sense of the venture capital, but even within regions where you see a fair amount of venture capital, like the Boston area, like the Bay Area, the venture capital tends to be focused around kind of the center city, and the kind of Kickstarter campaigns we're seeing more in the suburbs and kind of surrounding smaller cities that are near there. So there does seem to be, kind of a different geography in some sense to what's getting funded by crowdfunding, which suggests that, these really are opening access, at least to some entrepreneurs that are looking for things. The next thing that we wanted to look at, though, was, well, what's really the relationship between venture capital and, in this case, Kickstarter? And so for that, we looked at, essentially how do these sort of flows change over time? So if a county gets, say, a successful Kickstarter campaign in this year, how does that affect future crowdfunding? Basically what we found is that it increases the likelihood of future crowdfunding, or sorry, future venture capital funding. So it seems like what's happening is that either venture capitalists are attracted perhaps directly to the companies that have had a successful Kickstarter campaign, and so therefore are providing sort of future financing for those companies, or perhaps they just become more aware of the area because it's now had this successful campaign. And so not only does the Kickstarter campaign then have in some sense a beneficial immediate effect for a particular kind of county, it also may have a longer run beneficial effect to the extent that it draws future venture capital dollars to the area. Now, we still might worry that, to some extent what's happening is that there's just, kind of common interest in, certain types of projects, right? This is, in the sort of language of econometrics, this is an endogeneity problem. So one of the things that we used for that is we used an approach where we basically looked at what seemed to be the demand for, or you could think about maybe even the supply of Kickstarter dollars that's unrelated to the types of investments that venture capitalists would invest in. So essentially we went back to this matrix and we said, well, we've got these blue areas, which are the things that they, invest in common, but we also have a bunch of red areas. We have things like, comic books and, photography and a bunch of things that, are interesting for Kickstarter funders, but aren't necessarily of interest to a venture capitalist. And we said, well, let's use the successful campaigns in those areas essentially to predict the likelihood that there would be successful campaigns in technology areas, and then see whether or not that explains the relationship and what type of relationship it explains between crowdfunding and venture capital. So again, now we're using things like, funding for the first women filmmakers or for, kind of veterans television. Lots of, oftentimes, entertainment related things. So what we found is when we, use that as sort of our approach to estimating the effects, we still find that there's a positive effect between crowdfunding or Kickstarter campaigns and venture capital campaigns. And in fact, we can even segment off to some extent where that effect is coming from. So what we did is we estimated separately for every year the relationship between crowdfunding and venture capital. The green line is looking at all Kickstarter campaigns. Now that even includes ones that are not successful. There's very little relationship between the overall number of campaigns and sort of future venture capital dollars. In some sense, that's a good thing, right? If there were a bunch of unsuccessful campaigns that no one on Kickstarter wanted to invest in, it would be surprising if those were things that venture capitalists would later want to invest in. The red is just looking at successful Kickstarter campaigns in these matched categories, right? So in the categories that are similar to what venture capitalists are related in. There's a stronger relationship there. These are elasticities. So basically a 1% increase in venture capital is increasing the amount, or sorry, 1% increase in Kickstarter is increasing the amount of venture capital by roughly, starting out close to 0, but by the end of the period, almost 0.3%. In terms of the amount of venture capital in the area. And then what we did is we said, well, there's still some things in that set of matched categories that maybe aren't as interesting to venture capitalists. So business services, the description of business services sound oftentimes similar in Kickstarter than what you get in some similar types of businesses in venture capital, but maybe they're different types of things. Maybe one is somebody who wants to open a local shop, and the venture capital backed one is somebody who's thinking about a franchise of a particular type of service. So what we did is we decided to focus in on just the technology campaigns, because those are the ones that have the clearest overlap. And in the technology campaigns, indeed, you get the strongest relationship between successful Kickstarter campaigns and future successful venture capital campaigns. And in fact, the elasticity over time is getting higher, right? So it seems like this is becoming a more important route. We can even compare the ratios to think about where does most of this relationship seem to be coming from. So if you compare the relationship of all Kickstarter campaigns to the successful campaigns, it turns out that basically all of the effect seems to come from the successful campaigns. That seems to be a good thing. If you compare the size of the successful campaign effect to the technology campaign effect, and you adjust for the proportion that they are of the totals, it looks like about 88 to 90% of the effect is coming just from the technology category, rather than from other types of businesses. So, I want to cycle back very briefly to, kind of the opening question. Does it seem like the crowd is expanding innovation? The answer, I think, is yes, at least if we're sort of thinking about that expansion question with regard to geography. I think one thing that's interesting, if we sort of think about maybe this is pulling venture capitalists into some new regions, is to what extent does this have a hope of, kind of making a dent in this current concentration of venture capital? Will it spread venture capital more broadly? So I think with that, I left enough time for, kind of one or two quick questions before I introduce the rest of the panel.
In the last 12 months, what's the total technology venture capital Kickstarter dollars?
Oh, that is a good question.
I'm sorry. Want me to repeat that for the record? I'm asking what the total dollar volume of Kickstarter technology placements for venture would have been in the last 12 months, or 2016 even. Thank you.
Yeah, I don't know off the top of my head. I mean, I can think about what the overall numbers are for the period. But I can't remember what the breakdown is for each of the last few years. I mean, clearly it's been growing rapidly. Over the whole period, we're probably looking at numbers that are on the order of, less than $1 billion. Yeah, for sure.
Did you watch the first Stranger Things?
Yeah.
If the Fed begins to raise interest rates, do you see a pullback in venture capital, or do you see this as, just easy money chasing few opportunities right now, and that will pull back with interest rates, or is this something that's likely to stay?
So when you say pull back in interest rates, you mean increase interest rates, or?
Pull back in venture capital, increase in interest rates.
I think that to some extent, kind of Kickstarter campaigns become more attractive if interest rates go up, because you could think about it as being a little bit like a form of trade debt, except that there's no kind of nominal interest rate, right? So if I run a Kickstarter campaign today and get donations, I don't have to pay any interest on that. So that's almost like getting an interest-free loan until I decide to deliver the product.
I guess what I meant more is from the venture capital perspective.
Yeah.
A lot of the general partners, right, are funded by pension funds looking for better returns than 0%. So that's what I mean. So if the interest rates begin to rise, do you believe they're...
I see. Well, I think it depends on why you think that the pension funds are investing in the venture capital in the first place. So, if you think that it's based on some projection of expected return, then it probably does make a difference. But if you think that a lot of it's driven by kind of more like diversification interests and the fact that venture capital has relatively low correlations, both with debt and certainly with large caps, it's a little bit less clear with small caps, then it's not so obvious that kind of a small change in interest rates is going to dramatically sort of shift allocations in that kind of diversification framework.
Thank you very much. My name is Juan, and I'm from UMass Amherst.
Should probably be the last question. Sorry, where am I? Right here. Got it, sorry.
Thank you. Yeah, so in terms of job creation, if we match the census data to the geometric distribution of these two channels, is it possible that we can see which channels of venture capital or crowdfunding contribute more to the local job growth?
Nobody's really done anything to try to connect crowdfunding to job growth. So in an earlier paper that I wrote, it was looking at whether or not there was a relationship between venture capital and job creation. Kind of one of the central findings was that the earlier stage the venture capital, the more important it seemed to be to job creation. It's probably because the method that we're using is really trying to think about what might be substitutes. And as you get to kind of later stages, there's probably more substitutes available as alternative forms of financing, whereas at earlier stages, venture capital really is playing a critical role in sort of getting companies started or kind of growing in that first period. I could continue for a while, but we have a whole panel here with their own expertise. And also, crowdfunding platforms are certainly just one aspect of FinTech. And I think there's lots of other interesting aspects around them. So I'd first like to invite up the panelists. So I will just go in alphabetical order. So Dan Ciporin is a general partner at Canaan Partners and has been for more than a decade. He's quite relevant to the panel, also in particular to what I was presenting, because he's invested himself in, or at least as a partner with Canaan Partners, in multiple crowdfunding platforms, including the Lending Club, which is a leading peer-to-peer lender, as well as CircleUp, which is probably the leading equity crowdfunding platform in the United States. Also, I would be remiss if I did not mention that he is a Yale SOM alumnus. Dan, welcome. Next up, we have Sally Rocker, who is a managing director and general counsel for J.C. Flowers and Company. So for the last 17 years at JC Flowers, she has been an investor in a variety of different types of financial service companies, from banks to insurance companies to reinsurance companies, and she serves on the boards of 4 banks in both of both Europe and the United States. And again, I am pleased to say that she is also a Yale SOM alumna. Third, we have Gary Stern, who is former president of the Minneapolis Federal Reserve Bank. He serves on the board of E-Trade, as well as several other organizations and companies. And he has a PhD in economics from Rice University. Please welcome. And last up, I'd like to welcome Paolo Zanoni, who is an executive fellow at the Yale School of Management and chairman of Goldman Sachs Italian division. He was formerly the co-CEO of Goldman Sachs Russia, and he teaches a course here on deals. So Paolo, please welcome up. All right, so I'm going to kick things off with a couple of questions. And then, kind of after we've maybe done a few initial questions, we'll open things up for the audience. So, Dan, I'd like to start with you, in part because I think that, a lot of what you've been active in as an investor is very closely related to some of the research that I've been doing. Now, Kickstarter is a donation-based platform in the sort of parlance of crowdfunding. But you've been an investor in both, debt-based platforms as well as equity-based platforms. And I was wondering, so here, there seems to be a complementary relationship. Do you think that those are also likely to be complementary to venture capital as a form of entrepreneurial finance? Or, are you basically financing the, people that are going to replace you?
Well, first of all, I think it's fascinating research. Would love to see if potentially we could get you talking to the Circle Up folks to see just how that's happened in that realm. And for those of you who don't know, Circle Up is an equity crowdfunding platform. It is focused exclusively on consumer product goods, CPG. So the thesis going into the investment is that CPG lends itself much better to crowdfunding than technology, for example, because CPG is something you can touch, you can feel, you can see it in your Whole Foods local store, and you can have an emotional connection to that product in a way that is not as possible with a technology-based product. So, so I think that it would be very interesting to see how that unfolds. We, by the way, only take accredited investors in Circle Up. We specifically decided to stay away from Jobs Act, all individual equity contributions for a lot of reasons. And I tend to think that the Jobs Act, and this may be a little bit of a digression, but I tend to think the Jobs Act is a very interesting policy, very well-intentioned policy. I have a lot of concerns about how it will actually play out, in fact, and I think there's potentially a lot of tears, if you will, that may ultimately come out of the wholesale expansion of that policy. But I do believe that very much that your thesis is correct. I think that there is no question that there is a similarity bias in venture capital, both in terms of diversity around the people, but also diversity around geography. And we're always trying to be very conscious of that. At Canaan Partners, we have 9 general partners. 3 of them are women, and we have about half the firm is minority. So we try to really address that head on. But I have to say we're all based in New York and in California, so the geographic diversity is something that we have a harder time with. And there are a lot of reasons for that, particularly the sort of bench strength, if you will, of the engineering talent in any given area. We made an investment in Chattanooga, Tennessee, which we're very excited about. But I will tell you that one of the biggest challenges we have, there's a great product market fit There's a great team in place. We have a lot of trouble getting high-quality engineers, and it's a very, and that resource is a precious resource that, that we absolutely need to have. And I think to the extent that you have more and more engineering talent going broader and broader in the country, that will help, I think, as much as just crowdfunding in general. But no question that crowdfunding raises awareness of different kinds of companies in different kinds of places outside of the Silicon Valley and New York ecosystems. I think I think that your research proves that, and it intuitively and anecdotally feels very much right to me as well.
Okay. Let's go from the kind of the smaller size of deals. Paulo, I'm going to kind of call on you next. So you teach a course here called Deals, and the deals that are in that course are big deals, right? I mean, we're not talking about these kind of little, right, $1 million investments. We're talking about $1 billion M&A, $1 billion IPOs. I mean, do you see a place for something maybe with institutional investors coordinating on a platform as a potential challenge to the role of investment banks, or is there just too much kind of coordination or expertise involved for that to happen?
Let me step back and see if I can answer your question. And I will start. One of the big questions when people look at FinTech, one of the big questions that is being asked, or not being asked, but is in the back of the mind of most people that are looking at it, is what is going to be the impact on FinTech, on large, established financial institutions. Clearly, Goldman is one of those large, established financial institutions. So I would like to take the impact, to look at the impact, or the potential impact so far, and on the activity, because we have a big activity on principal investment, and so on the activity of investment, and also on the activity on the capital market, the access to capital market. So if you consider Goldman, let's forget for a second one of the big business lines, which is asset management and private wealth, and let's focus on the other three. You have the advisory business that you divide in access to capital market and M&A. You have the trading business, and you have the principal investment business. Now, all these three businesses have been heavily impacted by the development in the FinTech industry. The advisory business is the most obvious. It is difficult today to be in the advisory business if you do not understand or take into account the impact that innovation in the financial industry and innovation in general are having on your clients. And so that's a really big impact. Now, many of our equity analysts have got to become able to understand and to evaluate the variables that will impact how those variables will impact their client. The same is true for the M&A bankers. Regardless of the industry or the geography in which they are operating, of course, everybody who is in financial institution cannot do his job these days if he doesn't have an idea of variables, developments, and trends. Let's move to trading. The trading business so far has not been impacted, but potentially is a business that is likely to be impacted the most. And as a matter of fact, probably the largest group that today within Goldman is looking at the impact of the development in FinTech on the firm resides today in the trading business. Everybody that I know of that is evaluating either for his own business line or for the executive office, the impact that FinTech is going to have on Goldman as a financial institution resides in the trading business. And we can discuss it at length if you want, but some people resides in the securities business and the settlement business. Other resides really in the trading business and are looking at the impact or the possibility of creating a trading platform for FX, for instance, or for other type, or for bonds. Or another group, of course, is looking at the smart contracts and the impact that they will have on the ISDA regulation and and all the trading that revolves around them. And after there is the third part, and is a part that looks that impact us as investors. And I would say that today, a large part of Goldman is a reasonable part. You've seen news on the Wall Street Journal today. A large part of Goldman principal investment activity is looking at FinTech as an area where Goldman thinks that it's useful and is rewarding to invest, or where it has to invest. And I will focus on the second one, if you allow me, because the leadership of the firm has decided that in the medium term, very little growth is going to come of our traditional activities. And so some of the growth for the firm is going to come from new activities. And the leadership of the firm, I think rightly so, thinks that if we are trying to develop new activities from the existing business, we are going to kill them. We are not going to develop them, because we are going to look at these new activities with the eyes of the old, and the eyes of the old are probably biased. And so most of Goldman developments in new activities it's done by the principal investment arm, by buying new businesses. And clearly, we are buying new businesses in the FinTech area. Most of them are reasonably big. We are talking about several $100 million of equity values. Some, like NanoPay, are very small, and they are bought more, and they come. I come to your point at the end, and they come very close to reasonably innovative small business where we would like to see the developments, and in addition, we would like to learn how to do those things, because we don't think that we have the know-how in-house. Sorry, I've gone for too long.
Oh, that's all right.
And I've taken it far. I didn't answer the question, only at the end.
Yeah, well, there was a little bit of the answer in the
And
trading.
a little bit.
That's right. So Sally, let me come to you. So both, both Dan and Paulo were talking a little bit more about, kind of platform issues. In banking, it seems like a lot of, kind of the interest in FinTech and potentially disruption due to FinTech is more around, kind of transaction costs. So, there's been some research suggesting that, the cost of transactions, and therefore, in some sense, the revenue to banks, could decline markedly over the next decade by as much as, kind of 25 to 40%, which could probably lead to even further consolidation of, the banking sector in the U.S. How do you think that, who wins, who loses from that? Is it large banks versus consumers?
Well, that's, yeah.
That's right. I was directing this to Sal.
Oh, I'm sorry.
I will get to you. Don't worry.
Well, it's actually very interesting, because I'd really be interested in Gary's perspective as the regulator. But as both an investor in banks and as someone who's served on boards of banks, I think clearly the winner is the consumer. And there are three things going on today that have brought us to where we are. One is increasing consumer demand and consumer preferences. And the second is technology, where what we have is really fast evolution, faster and faster evolution rather than a revolution. And we have the regulatory overlay, which really does inform what banks are doing. It's also interesting that Paulo talks a lot about what Goldman is doing. 3-4 years ago, we would have sat here and talked about whether Goldman or JP Morgan or any of them would even exist in the future, or would they be disrupted Whereas today, those institutions who were seen as the dinosaurs, who are going to be replaced, are now seen as the capital are the capital providers for innovation, in large part. And so to get to your question, I think technology is rapidly changing the revenue stream. I think it's going to become more and more efficient. I don't think that means banks will be eliminated. But any bank who doesn't think of themselves as a technology company is going to be left in the dust. You need to think of yourself that way. I also would comment that many people think of banks as very staid, hasn't changed, they're ossified, they're stuck in the legacy. If you look at bank consolidation and the way the landscape has changed, I wrote down that in 1994, the top 10 banks in the world, 6 of the top 10 were Japanese. 1 was from the US, 2 were from Europe. Today, 4 of the top 10 are from China, 4 from the US, 1 from Europe, and 1 from Japan. So that landscape has changed.
By assets.
By assets, but absolutely. But in a span of only 23 years, and there were a lot of changes in between, where the European banks grew in assets. In 2004, 4 of them were from Europe, and now they've declined again. So I think there's been a lot of consolidation in the US in banking. In some ways, that's slowed down a little bit as technology has allowed some banks that might not have survived to continue to survive today. But
yeah, it's interesting. I mean, yeah, so you're focusing on kind of the largest, but we could also think about, kind of the smallest, right? I mean, I think in '94, the US still had around 10,000 banks. And, now we're down to, around 5,000 or something. So we've had a lot of consolidation in the kind of number of banks. Now, a lot of those are small, savings and loans, other types of local banks. But that's another type of consolidation. You're more likely now to be getting your mortgage, say, from a Citibank than from, a local S&L.
That will continue, in my opinion.
Yeah. So Gary, first I'd be interested in your thoughts just, kind of about the banking consolidation. But, kind of further, one of the things that seems, I actually like to kind of pull away from thinking about necessarily the fraud aspects of regulation and think more about, the Fed and its role of managing the money supply. And how does, the kind of potential for a lot of extra bank financial transactions, potentially complicate that policy role?
Well, in many ways, that second question is a very old question. I mean, because while technology may be playing a much bigger role today than was, say, the case when I first got into all of this was back in the 1970s, there was still, what was going on then was development of a lot of substitutes for traditional bank deposits. Money market funds are an obvious example, but they're not the only example. But in making that point, that the question was being asked back then, what will the Fed still be able to achieve its macroeconomic objectives, whatever they may be, say price stability and high employment, in a world where the underpinnings of the financial system are changing a lot? I think to date, anyway, that question has been answered in the affirmative. Now, that doesn't mean that the Fed has always gotten the result it desired, et cetera, and when it desired it, et cetera, et cetera. But I think it would be hard-pressed to say that the Fed so far has been reduced to sort of bystander status. And I personally would be very surprised if the next X years, say 10, that happened as well, irrespective of a lot of innovation in the financial world. On the, just one comment on the consolidation side. Yeah, there has been significant consolidation. The question that usually goes along with it is, well, what happens to Main Street businesses and households out on the prairie somewhere like Minnesota when the small community banks either disappear or are absorbed by U.S. Bank or Wells Fargo or whoever. And for some of the communities and some of the residents, those are not happy outcomes. But having said that, I mean, it really is true, and Sally commented on it, you can apply for a mortgage or an account or whatever online today, irrespective of where you are, and chances are you'll get it. So you can do business with just about any financial institution you'd like to. And so I don't see any persistent issues with regard to at least that aspect of consolidation.
How about with the idea that we shift from kind of having people making decisions to, say, algorithms making decisions?
I'm sorry, who making decisions?
Well, like, say...
Oh, algorithms.
Yeah.
Well, I don't think that's a terribly new issue in some perspective. Back in the part of the world that I come from, that was one of the traditional arguments about why Main Street banking ought to be preserved. Because the concern was that the big holding company based in Minneapolis, much less New York or San Francisco, was going to rely on algorithms, and a lot of reasonable customers would be turned away for that reason. If you think about, and I wouldn't dismiss that entirely, but if you think about incentives and you think about the way a market capitalist economy ought to work, and the way, in fact, I think it does work most of the time, if you have potential high caliber borrowers, that is, you believe they're going to pay you back, they're capable of paying you back, somebody will meet their needs. We were talking about crowdfunding earlier, for example. There's been lots of innovation. There'll undoubtedly be more. And if the banks pull back, I'm willing to bet a nickel that somebody will step forward.
Just a nickel.
Sally is betting more.
I'm betting more than a nickel. But one thing I would say is I think something that people have very short memories and have forgotten in the last few years is that the cycle of lending is a very long cycle. And it's not just the algorithm that decides whether you're going to get the loan. I mean, it's a business where you don't necessarily want to be bigger. This isn't Uber. This isn't Google that can really disrupt. Scale isn't necessarily better. You need a big balance sheet, and you need to see the cycle through. And it's a business, particularly on the lending side. I think we can talk about payments later, but where the losses appear a long time after the revenues are generated. And so I think there'll be a friction with the algorithm and human.
By the way, I don't know if we are right or wrong, but we are totally convinced that most of the data that you need today to make lending decisions are in the public domain. And so you really can make, on large number, a reasonably accurate and reasonably correct lending decision just without having the branch and without interacting with the person with whom you are interacting. What it really is important is having the capability of getting and evaluating the informations that are in the public domain. Right. And this is a really, really big change. And so legacy in the terms of brick and mortars, actually, it's not a competitive advantage, but it's a competitive disadvantage.
Yeah, I would agree with that. I think, one of the challenges when you think about the better underwriting sauce, which is, a lot of what certain fintechs will pitch, lending fintechs in particular, you can actually construct a much better set of criteria around lending than you do today, but it will be very illegal, right? You cannot, there's certain things you just can't do relative to who you choose to lend to and how you make that decision. And a lot of the, I know, for example, at Lending Club, but also at a variety of different banks and other fintechs, one of the big challenges is trying to address the massive amount of data out there in the public domain, of which there is, the amount of data that is out in the public domain now versus 5 years ago is exponentially greater. But how do you address that in a way that is accurate but also compliant? And that's not an easy task to do. So I think it's not just about the secret sauce of underwriting, it's also about the secret sauce that is fully compliant. And
well, that's what I mean, I wonder, it almost sounds like this is, an example that, Blythe was talking about almost, where you're, you're skirting the regulations, and that's what's allowing for, the sort of a play. Is that what's happening in these?
Well, I definitely don't agree with that. I can tell you Lending Club is, first of all, has to comply with every single marketing regulation that is put out by the United States or by different states. They do that through a bank. It happens to be Web Bank. But there is no leeway given to Lending Club by virtue of the fact that it is not a bank. Now, what it doesn't have that a bank has is the regulatory umbrella of being a bank holding company. And so you can say, well, that's an advantage. True. But let's not forget what a bank holding company gives you, which is access to the FDIC and the insured deposits that a Lending Club or any other non-bank doesn't do. So I think that is a reasonable quid pro quo relative to kind of regulatory constraints and speed bumps. But I do think, and just to maybe touch a little bit on the topic of consolidation and crowdfunding, there was a recent study done that was submitted to the Fed that said, or at least demonstrated in the study, that Lending Club actually, by virtue of being a kind of nationally based, online-only lending operation, did in fact reach different geographic areas than traditional banks, and did in fact offer lending solutions to consumers that would not have been able to be accessed in any other way, or at least weren't being accessed in any other way. So I think that there's a large advantage from the fact that that peer-to-peer marketplace lending companies can in fact address lots of different constituents in different ways than maybe a traditional bank, and certainly a bank branch-based bank could do.
So I'm going to open this up in just a minute, but maybe to ask one last question while people are sort of thinking about what they'd like to ask. I'd like to draw attention to kind of a segment that we haven't really talked much about, which is insurance. So I think actually, Dan, one of your partners has gone on record saying the industry is ripe for sort of disruption. Sally, certainly you've been involved with a number of insurance companies. What is the potential? Is there a potential for FinTech to really change the insurance business, and if so, how?
Yeah, absolutely. We love insurance as a place to look at disruption, not necessarily to replace insurance companies, because when you talk about regulatory constraints, banks are laissez-faire, free for all, I should say, versus insurance companies and how they're regulated, which is obviously state by state. But we funded recently a company called Ladder, which is a company that it's a life insurance company offering life insurance online. But unlike most other life insurance companies, which offer you preliminary acceptance online, but then you have to go in and do a fluids test of some kind in order to actually get the policy approved. Ladder will offer you, based on data, will offer you the policy right online within a matter of minutes, and that is really kind of marrying big data to life insurance. Now they're working in conjunction with a reinsurer, a very large reinsurer, but the fact is that front end is all theirs in terms, and the back end of analyzing the data and making sure that they're making a decision that is in fact, from an actuarial standpoint, the right one, but doing it without requiring fluids, or which is, if you look at the conversion funnel on insurance, I mean, the drop off on that is absolutely massive, because not so much because people are scared of giving fluids, but it's a hassle, and a lot of times people just don't follow through. So it marks a fundamental change in how insurance is given out and marketed. And I think there are lots of different examples like that out there.
I think there's no question that technology is going to disrupt in many ways how insurance is offered and decisions are made. I certainly wouldn't write off the big companies, and one of the things we haven't really talked about is valuation of FinTech ideas, and there's a big difference between a tech idea and an enterprise-ready company, and Dan certainly lives that every single day, as do we. I think there's also a lot of space in insurance as well as banking not necessarily around the underwriting decision, but around all the other aspects, of which there are many. And I do think that you're going to see rapid evolution and new entrants in those spaces.
Do you think there'd be new entrants, or it'd just be changing the way that the existing sort of insurance?
I think both. I think both. But I think particularly in the insurance space, I mean, there are some big incumbents who have a first mover advantage they're going to continue to have for some time.
Gary? I want to steal your...
I don't know that I have anything to add to that. My impression is, and Dan alluded to this, that there's a lot of, because of all the data that's now available at low cost, and cost of information has been declining substantially for decades, that you could do a lot of fine tuning in the insurance business that you could, at low cost, that you couldn't do before. And so that looks to me like, disruption waiting to happen. It's probably underway, but it'll probably accelerate from here.
I think it is underway, and I will give you a very impressionistic answer, but short this time. When our teams meet with private equity firms that want to make investment in the FinTech area, the biggest industry that they ask us about is insurance. And they are looking for a reasonably small, but not for ideas, for a reasonably small going concern that are in the insurance industry, and again, that are based on either way to service large insurance companies or more innovative ways to evaluate data, the big data that is in the public domain, and that is going to be very useful. And they are looking for sizes from, I would say, $20 to $100 million investment in this area. And it's probably one of the most sought after areas by private equity firms, traditional and innovative private equity firms.
All right, so I want to give the audience a chance to follow up with some questions. I see a hand right here. Let's start up.
Question for Sally. Sally, you said that...
Yeah, can we use the mic just because it's...
Thank you. Sally, you said that banks need to think of themselves as being in the technology business. Would you elaborate on that? A bank that thinks of itself as being in the technology business, what does it do differently than banks that don't?
I think it needs to, like all institutions today, to constantly think about whether they're delivering the products and services that consumers want in the most cost-effective and efficient manner. And the most obvious example is the mobile payments, mobile phone, right? Our children, our future generations are not even going to go to an ATM to get money. They're not going to transact that way. They're already not doing that. And so I think recognizing that and delivering a product that's using that distribution means is what I'm talking about, is they can't shy away from that and expect to survive.
Question here.
Yeah, sorry.
Right here, to your left.
Yeah, there you go.
Hi. As someone who operates in the idea early stage side of business myself, and I interact with lots of startups or work with them, I'm fascinated by all these new developments that you see in the funding space. Now, we talked about crowdfunding and Kickstarter, and you mentioned Oculus, but on the flip side, when Oculus sold for $1 billion plus, none of the backers got anything out of it. Now, I'll be interested in the panel's viewpoints on some of these new distributed consensus funding mechanisms. Most famous of the one being the DAO, Democratic Autonomous Organization based on Ethereum, that failed not because the idea was bad, there was a problem with the code and so on. We can, that's a separate story. But I'd be interested in your viewpoints, whether you see that as a threat or an opportunity when you have a venture fund without having the need for general partners.
Are you talking about ICOs specifically, or?
No, I'm specifically talking about the DAO. I don't know if you have heard of it. It was a distributed model that raised 150 plus millions, and just to see that a third of it being stolen by a hacker.
Well, I think they raised that in an ICO, if I'm not mistaken. ICO, for those of you who don't know, is an initial coin offering, not an initial public offering. And there's a lot you could talk about. You could spend an entire day on blockchain and what it means and where things will add, both in terms of FinTech and other industries as well. I think with respect to your specific question, an ICO is basically not an equity play. So you are actually buying a piece of the protocol, if you will, and whatever applications are developed on top of that protocol, the coin gives you the ability to utilize that application. So you're actually not buying, when you spend money, 150 million, there are ones that are, Filecoin I think was 250 million. There's massive amounts of money being raised in ICOs that I'm not entirely sure people fully appreciate what they're buying, because they're not buying any equity stake. They're buying an option on the ability to use whatever application is being built on the underlying protocol. It's quite different, if you will, from the development of the internet, because the internet, of course, was all the money in the internet is being made on the application layer, right? So Google, Facebook, et cetera, et cetera. The protocol layer, HTTPS, that is not, nobody's making money on that. And the blockchain paradigm, if you will, at least certainly that the blockchain bulls will promulgate, is that this is a whole new way of looking at how you distribute data, and that unlike the internet, people are going to make money on the protocol, mostly, not the application layer. So anyway, I think if you're buying a coin on a company, Filecoin, for example, which is essentially a company that has put a white paper together, again, $250 million white paper, which says that we're going to distribute via blockchain the ability to farm out storage, basically. Your coin is simply giving you the ability to utilize that storage mechanism if and when it's built.
If it gets used.
So it's not an equity-based piece of the company you're buying. Again, I think important to understand when you talk about ICOs.
Olav?
Yeah.
Sorry, I didn't quite get the cage match I was looking for here, so I'm going to ask a question and try to do it again. Okay. Dan said, no big deal, not the regulation at Lending Club, except, of course, they're not a bank holding company. Gary, you didn't stand up and shout. So I'm going to do this again. I have a slide that I've used in my other classes that actually I picked on HSBC, where I take HSBC's business on their website, and I put it up, and then I take all the companies that are picking HSBC's pocket around the edges. And I look at I do a factor analysis to say, what are they doing that HSBC is not doing? The biggest thing they're not doing is being regulated. And they're taking business and they're taking market share away from HSBC because they're not being forced to spend money and time and effort kowtowing to the regulators. Now, the reason I wanted to bring the conversation back to that point is I really would like, that conversation is taking place here a lot. Because the question of whether or not the regulators should be looking over the shoulder of financial technology institutions. I will tell you, when we look at investments, I'm sure you do too, if they're being regulated, that's a real negative. If they're not being regulated, there may be a reason for it. Isn't there a reason for that regulation, Gary? If there's not, we can save a lot of money by just axing the whole thing in Washington.
Well, it's hard to know where to begin with that, Steve, in the sense that, you're not going to get me, first of all, you're not going to get me to defend the current regulatory structure and practice. I might have done that when I was still employed by the Fed, but I no longer am. So, in fact, I mean, I think the current regulatory apparatus is inefficient. It's ineffective, but that's not quite fair. It's not as effective as it could be. And it's indefensible, meaning that nobody would set this up if they were starting with a clean slate. But those things are kind of irrelevant because we are where we are, And there's very little interest in this country in regulatory reform, something that would bring some rationality, et cetera, to all of this. So when I say we are where we are, I would add, and we're probably going to stay here for quite some time. Having said that, your point about people are chipping away at HSBC or whatever, and should or shouldn't the regulators be concerned about it, and if they are, should they do something about it? I don't have a real conviction about that. I'm kind of torn, and I'm torn because I'll give you the economists on the one hand, on the other hand stuff. On the one hand, a comment you made is right. If it's worth regulating, then everybody should be subject to it should be the level playing field. Let's let it go at that. Although I've never met anybody in financial services who thought the field was level. It's always tilted in favor of the other guy, but that's another matter. On the other hand, if you take that attitude and you really mean it, I mean, you're going to inhibit innovation and competition and the resulting benefits for sure. No question about it. So where are we? Well, we're in a world of trade-offs. And for the time being, if I were the czar of this, and I am, you're all probably relieved that I'm not, I wouldn't rush to innovate the people that are after HSBC or whomever. For what is, I've already expressed one reason. The other reason is HSBC is a big, capable institution, and let's see what they decide to do.
Can I offer some counter position? Not counter, but I believe in the regulation of bank holding companies and banks in the following sense. I think they are more than just a business model. They are, in part, a social contract where, in exchange for the FDIC insurance, you get the stability of knowing that your deposit and credit decisions are safe. I think I agree with Blythe, who commented in the previous discussion that regulation should move more towards what the function is and what the activity is that you're regulating. I think there's a very big difference between the deposit and savings and payments. And I had dinner 2 nights ago with the CEO of a bank that we own. He said he doesn't think banks will be in the payments business, 10 years from now. And I think there is a real evolution, and that the regulators should be paying more attention to the function of what they're regulating, and not just, okay, you're a bank, so you've done these activities, so we're going to regulate every single one of them, and if you're outside the bank, we're not.
Can I get a rejoinder in?
Yes.
So, 2 things. I would be amazed if the banks were out of the payments business in 10 years or X years. I mean, you could tell lots of interesting stories about how that might happen, but replicating transactions accounts in scale globally is not an easy undertaking, and I'm not sure. I'm not sure the economics are there, and I'm not sure that the demand, quite honestly, is there. Putting that aside, back in the early '80s, the Minneapolis Fed published an article written by Jerry Corrigan, who was president at the time, called "Our Bank Special," and he argued yes. And I won't go through the whole article in the interest of time, et cetera, but the first characteristic of our bank special in answering that question was, providing accounts payable on demand at par, transactions accounts, demand deposit, checking accounts. And not only do I doubt that that system is going to be easy to replicate or substitute for, but the real advantage that banks have that hasn't been commented, I mean, the FDIC is fine, but the banks are the ultimate source of backup liquidity in the economy. Why? Because they have access to the Fed discount window. Now, a few other entities now do as well.
That's why Goldman is a bank.
Yeah.
Exactly right.
And there are some central
One
counterparties
reason.
that now have access to, but that's a big advantage, a big advantage.
Agreed.
Let's not lose sight of that.
Sally, I will tell you a story that I'm sure you would love it. For Goldman, even now, but 20 years ago, lending to clients was a bad business. And so every time a client asks one of us to lend money in exchange for an equity offering or an M&A offering, we had been drilled to tell them that they really didn't want us to lend them to them, because if they really needed the money, we would have been out of the game because we were not a bank holding company and we did not have access of the Fed window. So every time that a client asks you to do something where you're losing money, that was the perfect, that was actually true, and that was the perfect excuse to say, you know, I cannot lend to you because it's damaging for me and is useless for you. Now, that excuse, unfortunately, has evaporated totally. And now when a client asks you to lend him in order to give you a piece of business, you have to eat the cost.
Yeah.
Which makes it less profitable, the other piece of business.
I think what Goldman has done in this regard is fascinating because, I do think banks have used regulatory constraints as a moat. They'll complain about it all the time, but it's a big moat. It's a big competitive barrier. And once you are a bank holding company, much as Goldman, I think, would not necessarily at the time have said that was a good thing to happen, they've actually, I've been impressed with how they've strategically leveraged it. They've got Marcus, which is a consumer lending platform that is a balance sheet lender, not a marketplace lender. They bought a bank from GE. They've now got, they just passed $1 billion in originations after a year. I think they're closing in on $2 billion. And they're doing that all through their deposit base and through leveraging the fact that they are a bank holding company. So there are certainly lots and lots of constraints and issues around being a bank holding company. And there's no getting around that. But I think that what some people I think may fail to appreciate is how much of a competitive moat that provides once you are a bank holding company.
Well, you've probably seen that at Lending Club, where there's been a lot of friction and attention on the liquidity providers.
On the liquidity providers, exactly right.
Yeah.
And we, at Lending Club, so first of all, at Lending Club, I will say, again, I don't think there's anything you can point to, certainly on the marketing side, in lending, that a bank would would have to do that Lending Club wouldn't also have to do via web bank. But they basically are under the same regulatory umbrella. But to your point, Sally, they are not a balance sheet lender.
Right.
There's a little bit of a hybrid model now going on, but the primary source of funds is from other folks, whether they be retail or institutional. Whereas Goldman has leveraged their platform to be purely a balance sheet lender. And obviously the liquidity on that is
in good times, it's a lot easier than when anything
right.
goes wrong.
Right.
Yeah.
All right, well, we could continue on this for a long time, but I am cognizant of the fact that actually they restarted the countdown, perhaps just so that when I looked up, I would see it counting down again. But we are at lunchtime. I'd like to thank all of our panelists for joining me. And does somebody have details of where the lunch is? Sorry.